Good morning, everybody. Thank you guys so much for joining. Good morning to John Walkup.
Good morning, Noah.
Good morning to Jonathan Miller. I was waiting to say that. Good. It sounds great. We should do this more often, Jonathan, like once a week.
I'm
You know,
listen, I'm happy to. I always
is that
love
too
talking
much?
to you guys. It's always fun.
We should
Is
shooting
da
the
is
shit with
daily
Jonathan Miller.
basis too much? I mean, yeah, 15 minutes a day. That's all we ask, Jonathan. I mean,
A
just,
quick 10 minutes every
yeah,
single
Yeah,
day.
that's then that becomes like exercise. I don't
right.
know.
That's true. That's true. It's too much like we don't exercise over here. No. But you know what? I'm really thankful that you're taking some time out to talk to us. We got some good questions, good topics. We're going to do what we usually do over here. We're going to talk about a couple of things for about 20, 30 minutes, and then we're going to do a speed round. We got questions from the audience, and we're just going to speed round it. So hopefully everyone that's here has some good takeaways. This is all about intelligence. So this is an intelligence session. Jonathan, I'm going to introduce you, say some kind words to you about you. President and CEO of Miller Samwell, real estate appraisal and consulting firm since 1986. So
Yes.
this is like, oh my God, like 40 years at this point.
Yeah, it's our
That's
40th anniversary. Uh
Wow.
unbelievable.
yeah. Yeah, that I try not to think about that, not because I don't like being older, but I just don't know where the time went. It's sort of
Well, you look
blinking.
great considering 40 years in the machine. You know what I'm saying? You look great, handling it with
Thank you.
grace and elegance. State certified real estate appraiser in New York and Connecticut. You do a lot of court testimonies, expert witnesses. You're in all the media outlets. You do about 5 billion worth of appraisals a year in the New York City metropolitan area. So this guy knows what he's talking about. And I want to give you a plug. Since about 2015, you've been the author of Housing Notes, a newsletter that provides unique insights into the real estate vertical. I am putting that link in the chat right now. Subscribe to Jonathan's Housing
That's
Notes
a
if
good
you
one.
want. It's great. And Jonathan, thank you again for being here. We're going to talk New York City real estate. But first, I just want to ask you, what are you up to these days? Tell me what you're doing. I know there's been some changes
Well,
going on.
the one thing I'm not up to is I'm not doing Douglas Elliman market reports anymore. I did those for 32 years. I literally in January I woke up one morning and said, you know what? I've been doing this for 48% of my life. And I did the math, and I figured it was time for a change, and Elements time for a change. You know that they have all new people coming in, and we just mutually parted. And I've really been very thoughtful about what I want to do when I grow up. And as it stands right now, I'm writing a lot more, working on my book, and I've been talking
What's the
to
book?
5 or 6 entities to do market studies for them, but I don't know if I want to do that. So
Yeah, we want to hear about the book though. What's the
Yeah,
book?
what's the book all about?
yeah, so I have a book that I've been working on for a while, but I've accelerated it, and it's basically real estate stories that were made possible because of our appraisal company and people we meet. So I have a chapter on the on Madoffs, on the Rupert Murdoch. I have a chapter on the Alexander brothers,
Wow.
all that, and it's basically a combination of sort of you know sort of the craziness of real estate, the sort of the extremes we sort of run into in New York, and it's I think it's going to be fun. So
A
to
day in the
read,
life. A day in the
yeah,
life of Jonathan Miller, right?
yeah,
Stories, tales from the crypt.
yes. Hopefully not the crypt, but
Grab a cocktail, sit down, lower the lights, and read away. All right. Well,
but
that's going to be
but I just
interesting.
one of the things that I'm focused on is my Housing Notes newsletter. That's what I've been really writing a lot, and about issues, which we're going to touch on some of them today. But
Yeah.
it's a good, I think, resource for the brokerage community to sort of, I'm sort of doing my homework and parsing out how these issues impact them, or not necessarily them, but the consumers they deal with every day and what they read.
Yeah, and again, that link's in the chat. Join up. It's intelligence, guys, and we got to be on top of our game in this market. That's what it's all about. AI, agent intelligence. Let's start. All right, Jonathan, I want to start high level from your perspective, from your take. What's going on in the state of the market today?
So when we look at New York City Metro, the market is one of the more robust markets in the U.S. Compared to the U.S. I'm involved in a startup basically called Street Matrix, and I'm covering the West Coast pretty significantly for them. When we look in the biggest misunderstanding about, say, New York versus Texas, or is really inventory is the most important metric in housing. I probably said this the last time I was on the show. It still defines the story. So I just saw um, an article that was talking about how the market's going to correct nationally, and all the cities they showed were all in the Sun Belt except for one, and the other one was in Idaho, and it was because inventory there, from the outbound migration from the Northeast to cheaper housing in the South, they were able to bring supply in really quick. And they overdid it, they overcorrected. And that's why you're seeing, like Austin is sort of the poster child for declining prices. But in New York City Metro, rents are at or near record levels. I see no reason, especially with rising mortgage rates, for that to stop in 2026. We're actually seeing inventory decline. We're seeing uh, sales activity, rising. Basically all the sort of, when you think about the strength of a housing market, the New York metro area, especially the city, is doing quite well, despite all the noise and distraction that's surrounding our daily lives, which we could go on for about 5 hours about.
Yeah, there's a lot of that. But I want to talk about the Manhattan residential sales market for just a moment. I mean, you've talked about the rental market that's just going to crazy levels. I think everyone could resonate. So the sales market, you got tight inventory. Where are you seeing negotiability discounts? Where are you seeing prices over the last couple of years or decade? Like, what do you see going on generally in the sales market?
Well, you and I have talked at length about the fact that Manhattan has been essentially flat for about a decade, in terms of pricing. But in 2025, the year over year, every quarter that we've tracked has seen prices rise modestly, but sort of that upward sort of inflation tracking perspective relationship. Um, pri Price, the way I think of prices in aggregate in New York City is flat, maybe a little bit of an uptick, depending on the submarket. There's more vulnerability in the lower half of the market due to reliance on mortgage rates, and mortgage rates are at 6.6 now, up from just a tick below 6. So that's 60 base. I mean, like that's incredible. Like, to think about
Yeah.
how much they've risen in a short period of time, and that's going to probably have more of an impact on the lower end of the market than the higher end of the market, I think, going forward, especially over the next 6 months, especially because we don't know how this is going to play out. Like, just recently, the Fed said, basically the markets are predicting the Fed will have no cuts this year, when prior to the war, it was one, definitely one, maybe two. Now it's none. Is what I'm reading. That could change in a heartbeat, but that kind of says that mortgage rates aren't going to go back to where they were, in February, in the near
So
future.
continued pressure in the lower end, but the luxury market, what are you seeing in the luxury sector?
I'm seeing good things in the luxury market, and more, meaning more transactions, and especially as you move higher, there's more of a disconnect with, less reliance on mortgage rates. And Wall Street, the financial markets, despite all sort of the chaos in the sort of macroeconomic space, is looking, the anticipation is that they're going to have a good year, in terms of rising value of equities than they had better than they had last year. And then on top of it, this week the New York State Comptroller released the bonus numbers for 2025, and 2024 was like at or near records, depending on how you look at compensation and bank and profits. But 2025 is way better in terms of profits in the industry, and that just directly infuses demand at the upper end of the market. So I feel I feel a lot better as you move higher in price in terms of performance than lower in price for 2026.
Hey, Jonathan, let me ask. I mean, I like how you open up under the hood here, and we're looking at sort of some of the subsectors here. And I'm wondering if, in your nearly half century of experience, if you've seen a historical corollary in which the luxury market is doing one thing, and then the non-luxury market, which is more finance dependent, is doing yet another. Because it's a weird bifurcation we're seeing in this market. We basically have two markets in one. It's really hard to put a single label on it because it really depends on, well, what is it what market are you in? I'm just wondering if this is something you've seen before.
Uh, Actually, I have quite a bit.
Okay.
That It's not necessarily a mortgage rate story, but there is usually, and I've seen the opposite, where the low end is booming and the high end is soft because of overbuilding or oversupply, like we had during, I mean, the story for like 5 or 6 years for new development leading up to the pandemic was there was a massive oversupply. Like we were talking like 8 years of unsold, including shadow inventory of new development. And then that was wiped clean, in 2020, when mortgage rates fell to the floor and everybody started to realize that they were mobile and they could buy homes wherever they wanted. The more affluent you are, the higher your net worth, the more mobile you are. And it wasn't that I think that's Zoom, and what we're doing here is like change the way the wealthy think about mobility and the relationship between their job and where they live. It just became a very different thing, and that has ramifications for Manhattan because all that supply was effectively wiped clean. And
Yeah.
going forward, like the pipeline, because of higher interest rates, is very dry. And I say this many times that I think 2 or 3 years from now, price growth for new construction is going to be higher than existing because the supply or the pipeline coming in is very, very restrained.
I
Can
mean,
I go ahead, Noah?
go ahead, John.
No, I was just wondering if we can segue that into the rental market. Are you going to see rising rents sort of compensate for the lack of supply on the new dev side?
Absolutely. I think the trajectory for rents, if more, a lot of it is, dependent on what happens with interest rates, because there's a cohort of the population that has been waiting for 4 years for mortgage rates to drop to like the mid fives or whatever, and they were really close. And we saw this sort of weakening of the lock-in effect, where people were starting to list their homes, and we're seeing a little bit more inventory coming on and all that. But now that's sort of out the window, and we have people sort of hunkering back down, or they're camping out in the rental market longer, which is keeping supply tight because they're waiting to organically, they normally would transition to the purchase market, and they're not. They're just sticking around because they're waiting for rates to fall. And I think that that's probably going to be a while, or it's random. It depends on the war and a lot of other things, the midterms, all that goes into the mix.
Jonathan, this new dev pipeline problem, we're probably 4 or 5 years into it, give or take, I guess,
Yeah,
since the
since the
pandemic, or maybe
pandemic
six.
cleared it out, right? It cleared out the excess.
Right. So there's no signs of that changing at all right now. Like even is it Because if it starts changing today, it's like, oh, I'm starting to see some signs that it's changing. You're not going to see that for 3 years anyway. So my
Exactly.
question to you is, if are you seeing any signs of it today? And is this something that we're going to have to deal with for the next 5 years, basically, because of the lag?
So the answer to that question is I'm not seeing, it doesn't mean it doesn't exist, but at least where I look, what I'm seeing, I don't see this burst of, interest. There's always hype about, new projects and things coming down the pike and all that. That's sort of the natural state of the development space. But in terms of actual a push out of a lot more numbers entering the market, I do think that's a ways to go. So I think you are looking at, a 3 or 4 year window of, yearning for the days where there was a lot of product to sell or to rent.
Yeah, this is an interesting
Yeah.
question. What about terrible quality of most new construction and that pricing now for the resale of it is less than what they paid when they bought it? I guess
Yeah.
it is that, I mean, this
Yeah.
is that a decay factor that's real? Like if you buy a new development on day one and then you resell it on year five, is the market kind of penalizing you a little bit on condition
Yeah. So I have
decay?
a theory about this. I've got to give it like a cool name to come up with it. But when a new development is marketed, you've got a sales office, you've got brochures, you've got online staff showers showing
Yeah.
the properties, you've got this heightened marketing effect. And effectively, what that does is that the developer is essentially poaching the potential upside in value for like the next 3 or 4 years. So what I find is that new development, just as a general rule, doesn't see us, the same rate of growth unless it's a unique building. I'm not saying this is how it always is, but in
Right.
my experience the general take is the developer is not only getting the premium for their price today, but they're also sort of getting some of the upside of the next 3 or 4 years and getting it today because they've only got one shot, and they're pulling out all the stops. So new development, for the most part, takes a little bit longer to start seeing upside growth. Unless it's, I mean, this is sort of a generic example. Individual buildings, certainly you can have new development surge or double or triple. But that's not the sort of general overview of how I see, what the developer's focused on. Future upside,
Right.
get it now.
Yeah.
Crazy.
All right, let's move on. I want to head now talking about the future, Jonathan, talking about the forward outlook. I mean, you kind of touched on this, but just, you mentioned that prices will likely, especially in the new dev sector, you kind of see a bit of a squeeze. Is that where you see the market in general over the next 1 to 2 years? Like what's in terms of the activity prices, how would you gauge it? I know your crystal ball is
S-
cracked, put together with duct tape, all that stuff. I'm just
And cloudy.
curious.
Wait a second.
What
You
little
didn't tell me I
what?
couldn't use my old dad jokes in this
Oh,
discussion.
sorry.
No
I've
dad
heard it.
jokes.
Okay. All right. Um,
You're banned.
I well, I believe in the beauty of repetition, Noah and John.
Okay.
So
Yeah.
I like saying the
So do
same
we.
dad jokes over and over throughout my career. So I do see upward price pressure, uh, especially at the upper end of the market because new development is going to be reined in a bit. Um, I do see this greater bifurcation of low versus high because of mortgage rates, sort of staying stuck. Right now, at 6.6%, mortgage rates are closer to 7 than they are to 6. I mean, that's kind of a weird way to think of it. And that has implications for, people that rely on mortgages, which is, you know, a a sort of reducing number. But anyway, transaction volume, I think we had the optimism in January and February. I saw 26 as being a more active market because of the gradual reduction in rates. We're seeing rates slowly slide. And actually, I believe that that's how you get out of this is having when rates fall really quickly, which is what in theory the new Fed chair that's going to be, go through the confirmation hearings wants, or that's why he was selected. And what that's going to do is backfire. That's actually going to create more inflation and make it harder to reduce rates. What I love is this slow. I'm a big fan of dull and boring, like a quieter news cycle, less craziness associated with all these whiz bang solutions for housing which do nothing at the moment, like the 50-year mortgage and all the programs that are being introduced. Just leave it alone and let the Fed do slow cuts. Obviously, this conversation has changed since the war began because wars are inflationary, just like tariffs
Yeah.
are inflationary,
And
and all those
there's no
things.
more cuts
There's no
in the
more
whole mix.
cuts. I mean, like
Yeah.
that's over. But if you think about it, if you cut rates really fast, you actually make housing less affordable because you create a frenzy. That's what happened coming out of the pandemic. The Fed kept rates too low for too long, and basically you wiped inventory off the face of the earth, and that made housing more expensive because the supply, it wasn't the rates. The part I always marvel about, I'm going out down a rabbit hole, but the part I always marvel about is people think that lower mortgage rates make it more affordable when they forget that the seller and the buyer get the same memo. And maybe in that, like what you look at, maybe in that first month, there's an opportunity to sort of get the house before the pricing goes up when rates drop. But in the reality, the seller becomes their position becomes stronger, and and so you're kind of moving up together, and that's why we have
Well, the
this.
rate goes down, the price
Yeah.
goes up at the end of the
Correct,
day.
right. But I
Yeah.
don't think people think that way. I think the general consumer says, "Oh, it's my payments will be cheaper," and it's like, no, because your principal is going to be more expensive.
Yeah.
So I think we're wildly over dependent on rates in housing in America today, for sure.
Well, that's one of the things that was really interesting is when rates were, and they did this long slide down. It wasn't dramatic. It was a nice downtrend, which was finally broken, by the events in Iran. And I'm curious, we got down, as you mentioned, we ticked below 6%, but you didn't have this groundswell of people saying, finally I can buy. I mean, and so do you think that they're waiting for a certain number, or are mortgages not as important as people tend to think they are when driving contract activity?
Yeah, that's really a great narrative. I when we didn't have this explosion or frenzy when we cracked below 6, I think that tells you that it's just incremental. That the rate declines were brought in incremental levels of inventory and demand into the market. It was gradual. I mean, mortgage rates before the war fell from mid-July to the end of February by about 60 basis points, but it was incremental. And then you started seeing upside in all the sort of national housing metrics for transactions, and it sort of built in our thinking for 2026. Now we're going into the big season, the Super Bowl of the housing cycle every year. And there will be an uptick in activity because, hey, that's what happens every spring, except for 2020. It happens every spring, no matter how strong or weak the market is. So really, the way to think, I think of like how we'll see how we're doing is just comparing it to last year. Year over year is all that matters in
Yeah.
sort of getting an idea. And right now, we're we're in Manhattan, we're a little bit we're kind of like right in the same spot as we were last
Yeah,
year.
even a little lower, even. I mean, I
Yeah,
feel like
yeah,
inventory is lower, demand's just a little lower, but it's
yeah.
like just
And you think about like
slugging.
you would think that inventory would rise with greater uncertainty. Like I like to say, this is a dad joke you haven't heard before, but that we're we're at peak uncertainty, and 2 days from now it'll be peak uncertainty again. Like the goalposts keep moving down the road that our peak uncertainty has peak uncertainty. Like and so you
Yeah.
think that everything, inventory is coming down, you would think it would maybe go up because people become desperate or whatever. But the reality is they don't want to become a buyer if they're locked in at 4% and mortgage rates are 6.6, right?
I mean,
And
it's a great point.
or if they're
So
not going to get their price. Sorry, John.
Yeah,
yeah,
they're
and
not
I
going to
was
get
gonna
their
say,
price, right?
I remember on there used to be a chart we had on UrbanDigs we call it the volatility index, and basically and essentially it was off market, and it was the funniest thing to see that when times got uncertain, off market spiked,
Yeah, it's got to jump, right?
which
Because
is kind of the opposite, right? So
yeah, like I grew up in an era where, early days for me it was like, hey, mortgage rates go up, inventory goes through the roof, and prices come down.
Yeah, it doesn't
But
work
but
that way.
because inventory is missing from the equation, prices go up. It's like
Yeah.
even though mortgage rates have doubled, like it's just a whole new math.
um,
Nobody said anything's normal out there. It's a little bit of a crazy
I don't
time
even
going
know
on.
what that word
Uh,
means anymore. Like it's
well, some people
you
say
said
that in 2020 the world fractured and we went to a parallel universe, and who knows what the hell's going on
yeah.
since,
yeah.
Well, that was a thing too. I think in the 80s, 90s, new math. I remember that. So maybe we're
Yeah.
living it.
Yeah, maybe.
Um,
Yeah.
I want to talk about the inventory. Private listings, touchy subject,
Ooh, I
Oh,
like it.
yeah. My
spicy,
favorite
touchy.
topic, actually.
I'm gonna say, ooh. Is private listings one of the reasons why inventory is tight, or is inventory tight a macro force that is happening mutually exclusive from any private listings that might go on? That's question number one, I guess. And then we can go into the
Yeah.
efficacy of
I mean, I
private
see
listings.
private listings. So, and it starts with the Compass three-phase marketing plan, which is the core business strategy for the largest brokerage firm in history in the US, 340,000 agents. Um, it makes the problem worse. It's a business decision on their end, but what it does is it obliterates price discovery. The whole intention of private listings, first of all, the introduction of private listings as their central business core started with misusing what the Bright MLS study, who I talked to the chief economist there about this study, which it was inferred that private listings get you a higher price because it's more exclusive, and that's absolutely not true. Um, but this idea became top of mind for me because I do periodic consulting for like Wall Street analysts that are in the housing vertical, and I remember an analyst about a little over a year ago telling me they're waiting for all the litigation to happen because when the seller finds out that only three people saw the listing and they accepted the offer, it wasn't exposed to as many people as possible. They were going to sue, and the buyers, when they found out that it was on the market for 18 months and they didn't know that at all, um, they were going to sue because there's no price discovery. Like that to me, that's the holy grail of
When
housing.
you say price discovery, is it almost like, all right, so it's not being exposed to the public open market, and therefore we don't know whether or not it's going to try and succeed or try and fail. Sometimes trying and failing is more indicative of price discovery than trying and succeeding because
Correct.
the market sees a price and the market's not moving on it.
It
So
doesn't act.
that's not the price. It must be a
Right.
little lower than that. Okay.
Yeah, yeah. I think what it'll happen is it'll create a lot more over time. It'll create a lot more price volatility, like inconsistent patterns. And by the way, 96%, at least what I've read, 96% of the private listings um, actually are sold in the public space, meaning that
So
it's
it's like a
more like the
pre-listing period, and then it goes to the open market.
correct. Correct.
Okay.
90, it's like 96%. It's like the vast majority, which tells you that private listings don't actually effectuate a sale. All it's being designed for is to control the market and recruiting of agents to go where the listings are, because listings are sort of bread and butter. Um, and if you are holding off a big chunk of that from the public space, then you have to go through one of their agents. And to me, it's like going and buying a car and not knowing that it has 2 million miles on it, even though it looks great. Like there's some, like to me, I, and maybe it's naive on my part, but I believe in full transparency on, for the consumer's biggest purchase decision for the most part, of their life. And they don't
Right.
know some key things like days on market, um, how many times the price was changed, all that sort of thing, which it's like, it's only like the seller has the right to sell any way they want. That's the argument. And
Well,
I'm
that's the
like,
thing. I mean, so like the seller has a right to try it, right? There's a comment right here. Let's just play devil's advocate, guys. Play devil's advocate.
yeah,
I love transparency. I'm one of those guys that I think everyone should see. Like we had a universal co-broke agreement, right? You sign an agreement and then we share it with everybody universally.
yeah.
Universally, Now it's a little different, but it says here, private is mainly used to test pricing and get
Yeah, I
units
wrote a
ready
post.
for
I
public.
wrote I wrote a post about this. It was called the fallacy of price testing,
Mhm.
and I told a story uh, about I was giving a speech to a bunch of Westchester real estate agents for the MLS. This is a long time ago, and I remember they said, "Why can't I just throw it on at a really high price and an Arab sheik from the Middle East will pay an exorbitant price for my raised ranch contemporary on a cul-de-sac in the middle of the suburbs?" And I'm like, there's a thing called the internet, right? And market research. And that's not, that's like everybody has this pie in the sky, a seller like, oh man, I hope, I know it's only worth 1.5 million, but if I can get 2 million, like that would be amazing. So I'll just throw it on at, 199 and start a bidding war, right? And there's a reason, like that's not a sort of a true scenario. Testing a listing when you translate it means let me throw it on at a wildly high price and see if it sticks and see if I get lucky. And that's like to have that to be the centerpiece of 340,000 agents marketing seems crazy to me and misleading and to a certain degree unethical. I'm very much against it. I'm very much for full transparency for these big. So you're in a perfect political situation where this was not scrutinized. The merger was not scrutinized for this issue, which was supposed to take about a year of scrutiny, and it didn't happen. So what we're actually seeing now is there are 2 states that have banned private listings. This is going to be fought at the state level, and there's 2 states that are about to enact it, and then New York City is looking at it too right now. And I think you're going to see a groundswell of this going forward. But here's the
Yeah.
thing. I'm sitting here talking about this, and then the assumption is, well, do you want it? Do you want NAR to control everything? Do you want Zillow to control? It's like, no, just because I'm against this doesn't mean I'm for the way business has been done. All I want is full transparency so no one can hide anything from anybody. That's my.
Well, you're in the data and analytics business. I mean, we're in the data, and so I feel the same way. We're in the data and analytics business, right? Compass has to look out for their shareholders. What I don't like about the whole thing is right now, especially, is that there was an announcement that they're gonna, oh, you know what? We'll share these with Redfin. We'll share these with Rocket. We did a little deal on the side. So it's just pay to play at this point, and
Right.
it's clear that it's not really for the benefit of the market and the consumers
Oh
that
no, it's a
will
business
help.
strategy.
Right. And if I asked, I mean, I don't know if Mr. Refkin's listening, but Robert, I would love to have your private listings and put it on UrbanDigs. Could I get that? Could I get it? Like, what am I gonna do? You know what I'm saying? It's not a level
Yeah.
playing field. So like that to
Right.
me from the data analytics side, full transparency. I've always been about full transparency. But I mean, there are arguments 2 and 4, and it's going to be a wild ride with the legal system to see how this all plays out. So
Absolutely. This is going
to
to
the
play
courts it
out for
goes.
quite a while. State by state, it's going to play out.
Right.
Washington and Wisconsin ban them. I forget the other 2 states that are close to enacting it. It's expanding. The groundswell is expanding, And maybe there's some sort of 4D chess thing about doing this initially. I don't know, but frankly, I don't care. I
Right.
just want
Yeah.
full transparency so that no one gets screwed.
And just a last question on this, Jonathan. Are there real world implications for this? And I'm wondering from your standpoint as an
Yes.
appraiser, if you get something that was private market and you get the price, do you look into the price discovery
Ooh.
aspect when you're sort of setting the value for banks, financial institutions,
Yes.
courts, etc.?
Good
Yeah.
question.
So my favorite saying in appraising is one sale doesn't make a market, right? So we're estimating market value, and I always use Jerry Seinfeld as an example. So, uh, what town did he grow up? I forget. I'm like Long Island, a town, and he was talking about I can't remember the name, but he was talking about his town, and he said it's an old Indian name for by the mall. And Massapequa, someone just said, yeah, it's an
That's
old
good.
Indian name for by the mall. And but like, he, grew up there, had boxes of cereal on all the shelves. And let's say I'm making this up, say it was worth $500,000. Um, and somebody bought it as a flip to like, hey, it's Jerry Seinfeld, and they put it on for for $2 million, right? And it never sells, right? And then 2 years go by and he says, screw it, and he puts it on for 550 and it sells in 3 days. Like, what was it priced in the market, right? You knew that because of price discovery. Like the market told you that it wasn't worth $2 million, whatever you thought it was. That we had that in Queens. Anyway, I don't know how germane that is to what we're talking about, but the idea is that the market doesn't care what you think, and
Yeah.
and the reason why it doesn't care what you think is because it's fully informed. And the definition of market value is a number arrived at by a fully informed buyer and a fully informed seller. So now you're going to have assessors, appraisers, lenders relying on numbers that are damaged in the context of the private listing concept. Price discovery has been compromised, and I think that's bad. You think about the trillions in the bond market that are backed by real estate, and then this
Well,
becomes this broad thing. There's all kinds of implications. And I'm not being a conspiracy theory person. I'm just like, I just think it's a sacred thing. Price discovery is important.
no, data wants to be free. All right, we're going to move on from this, but data wants to be free. And I mean, agents, have you ever gotten upset that there's something on Street Easy, but it's not on this site, or there's something on
Yes.
this, and we don't have it on UrbanDigs, and you have to go over there, and it's like, we've been through this before. Like,
Yeah.
look, this is why there's an MLS. This is why there's a shared system, and everyone's on the same kind of playing field. We'll get away from that. I mean, but
Yeah. Yeah.
yes,
Yeah.
good points. All right, I
Well,
want to go to
yeah.
speed round. John, last thought or no?
Well, I wanted one more question. I mean, you talk about
Fine.
tinfoil hats and the conspiracy theories. I wanted to ask, so Jonathan, this is one of the things you see on social media. You see a lot of these reports, like national media reports, talking about how there's 50% more buyer or more sellers than there are
Oh,
buyers, and
yeah.
just all of these weird things. I just want
Ah.
your quick thoughts on some of these charts that we see floating around out there.
Yeah, yeah. So it was funny. Today I was shared a blog post by a good friend, and he said, "What do you think about this?" And it was the blog post was how there was so much inventory growth in these cities that that there's going to be a collapse in housing prices in the U.S. And I said, "Well, look at the cities that are in the study. They're all in the Sun Belt." Right? And so like you have to be very critical. Critical thinking is, essential because social media is going for interaction. But anyway, you're referring to the Redfin, the study that comes every month now, and it gets so much SEO. And it's the latest one is, and I wrote a takedown piece of this because it's a travesty. It said that there are 50% more sellers than there are buyers in the US, not in like one location. Like you could make that argument maybe in Austin, Texas, where prices have fallen like 18% over the last year. Why have they fallen? Because there's so much supply that came into the market, right? So the idea that there are 50% more sellers, in my mind, nationally, not in a small submarket, would tell me that prices are correcting, prices are falling, and yet their same month they're releasing, if you look at every year for the last 3 or 4 years, price growth continues to expand, although at a smaller rate, right? So I'm not contending with there are more sellers than buyers in some markets and others, but to say nationally it's 50%, it gets so much media hit, and it's absolutely false, and it's based on a false. They're calculating number of sellers from the number of listings, but the number of buyers they're calculating, by contracts and then some other like baked in factor that is sort of the black box. But the problem is, like, if you're in a market like I was talking to a friend of mine who's a real estate broker in Westchester, and he has a listing, and he was just telling me, he was calling me about something else, but he's telling about this listing, and he said, I've got like 10 people circling. 2 people have just offered 20% above the asking price. And you're like, well, that's a case where you have 8 potential buyers if there was listings on one contract, right? So you're wildly undercounting buyers. The seller part is easy because you count listings, but the buyers, you have all these multiple people circulating, bidding on properties. I mean, I've told you before, like the house I'm in now, like I won a 30-way bidding war. Like, so is that 30 buyers? Yes, it is. But it's only one contract, right? So you have the Midwest and the Northeast that are devoid of inventory as a general observation. And you have the Sun Belt, which has surplus inventory, namely Texas and Florida. And then you have California, or the Western region, which is sort of in between the extremes. Some markets have a lot, some markets have less. But the notion that there are 50% nationwide, 50% more sellers is ludicrous.
Yeah.
Yet that comes out on social media every month, and everybody, all the major news outlets share it, and it's getting into the sort of public zeitgeist, and it's a disservice.
It's a doom headline.
Well,
I think we've used
yeah,
that in
they love the doom loop. I know we did. I feel like, wow, look at this one.
It's like, holy shit! What the hell?
Yeah.
All right.
How did I miss this? Okay.
Speed round. Okay.
Okay.
Jonathan, there's one rule in speed round: 60 seconds or less, man. Okay.
Ooh,
you're challenging my intellect here.
I'm going to give you a time to mentally prepare for this. John, are you ready? We're going to alternate pretty quick. Okay.
Let's go.
Yeah. All right.
Here we go, guys. And if you guys didn't get a chance to submit a question here, you can put it right here in the chat. We'll try to get to it. Market direction, Jonathan. Buyer's market or seller's market right now?
It is sort of in between.
Okay, neutral.
Okay. What's the stronger force, say, rates or inventory?
Inventory.
Are we in a normal cycle or something structurally different?
I think we're actually approaching a normal cycle.
Ooh.
Jonathan, I have to say you're doing very well for speed.
Yeah,
round.
you're really answering
3,
is much quicker.
This is I gotta slow down the questions.
The pressure
Jonathan,
is intense.
new rule. They have to be more than 10 seconds and less than 60 seconds.
Right.
Sorry. All right.
Okay.
Go ahead.
Forward outlook. Better market in 6 months or 18 months?
18 months.
I totally agree with that.
Yeah.
I almost feel like in a year and a half, I feel like we're just going to start a new cycle. I know. Is that possible? I feel like it's about a year.
That's how I'm thinking about it.
Yeah. Will transaction volume rise this year? Yes or no?
It's not a yes or no question. I'll say maybe a little.
Okay.
I mean, it's closer to flat than we thought.
Okay.
Right. Well, speaking of the year over year, if we're looking at next year, 2027, right around now, how do you see prices? Higher, lower, flat?
The same. Yeah, flat.
Okay.
Flat. Okay.
Pricing and strategy question. Do we price at the market and let the market do its thing, or do we price higher and leave room to negotiate?
I think it's really, I think you price at the market. because, and just to answer it, even though that's not part of this game, but I don't follow the rules. It is,
Maverick.
you have to remember as a seller that the buyers are really handicapped right now. I mean, bank lending is conservative, and they don't have, sort of the candy box to dip in and just pay whatever they want, you want for your house. So I think you have to be cognizant of the handicaps that buyers are working with right now in terms of financing.
Okay, this sort of leads into the next question here. What's the biggest mistake sellers are making right now?
That they're late to the party. That they think
Ooh.
they they
I like
they
that.
still think they have the strength they had a couple of years ago.
Biggest buyer mistake right now.
That they think well, I think that they tend to overreact. They think their hand is much stronger. They were dealt a much stronger hand now because the market's weaker than it was, but it's not that much weaker.
All right, moving on to supply and demand. The inventory crux that we're in, is this temporary or is this a long-term problem?
It's a long-term problem.
Parlays into this. Will New York City ever meaningfully fix this housing shortage?
I want to say almost, but I was told once that almost only applies to playing what is it?
Horseshoes and
Hand
hand
grenades
grenades?
and horseshoes.
Right.
So not in the near future, I guess.
No, it'll keep trying because it's in its best interest to have people that work in the city being able to afford to live in the city, and that's just not unique to New York. That's every small, medium, and large size city or town in the U.S. right now. That is the affordability crisis in a nutshell.
Well, don't worry, the city council is on it. And while we wait for that, is it better to rent or buy today?
Ooh.
I guess I'll answer. Well, I believe in buying. Uh,
The gap is narrowing. I mean, if the gap
think
between
so.
renting and owning was this a little while ago, it's definitely
yeah,
getting
I've rented a
I'm starting to think
good part
about
of
it.
my life, and I've owned a good part of my life, and I prefer the ownership part. And I'm not doing it as an investment. I want to be able to paint my office wall orange. So,
You are very
or do
eccentric.
whatever I want. Yeah.
Do rents push people to buy, or do they keep them stuck renting?
Both. That's half the problem. So, in the old, pre sort of housing pricing crisis, affordability crisis, it would push you into organically into purchasing because it was cheaper to buy than rent. But now with the price growth of housing and the more than doubling of mortgage rates, the people that really want to organically, they would move in, they can't, and so they're stuck in the rental market, and that's why rents are continuing to, in Manhattan specifically. Nationally, they're actually drifting a little bit lower, or the rate of growth depending on the market, but in New York, it is very tight.
Right. I want to go to a question from
Good
the audience.
answer.
And folks, if you have questions for Jonathan, throw them in. We'll try to get to them.
Right there.
Speaking of purchasing versus renting, is having the same unit on the market for sale and rent at the same time counterproductive?
I think it's bad. It shows
Just a
to me that,
desperation kind of thing.
yeah, it shows when I see a rental versus a purchase, same listing, I think that the price on the sale is too high. And so they're like, I'll throw this out there, see what I could get, and then rent, but if it doesn't work out, I'll rent it.
Yeah, and I almost get the feeling that that person's not living there at the time, so there might be a little more risk involved, a little more buy
A little
side.
more
Right.
detachment.
Right.
Yeah.
Yeah. If
Yeah,
the sheep is not going to
detachment.
buy
Yeah.
my ranch, maybe the electrician next door will rent it. Kind of
I don't
thing.
know any farming jokes. So,
I live on a farm and I don't know any.
right, right.
But
I
anywho,
like to think that, I like to think that I'm a farmer outstanding in my field.
you are. You're a farmer in the field.
Yeah.
You are whatever you want to be, Jonathan.
And you're
You
certainly
can do whatever
outstanding.
you want. When you grow up, you can do anything you want, Jonathan.
Absolutely. I'm still trying to figure it out.
Brooklyn or Manhattan over the next 2 years, which outperforms?
Uh, I think Manhattan for sales and Brooklyn for rental.
Ooh.
Interesting. Looking at the divide between luxury and non-luxury, is the luxury trend going to keep on chugging, or will the non-luxury catch up?
Uh, I think that the separation and growth will be higher for, say, the upper half versus the lower half. I think the luxury grows more than the non-luxury, and that's a global phenomenon right now.
Better bet right now, condo or co-op?
I still like condos for future growth more than co-ops because of the restriction on ownership. I had done a study with Furman, NYU Foreman, a while back, and the board just has so much more control in a co-op about impacts the value by about 10%, all things being exactly equal, which they're not, but just for the ownership. So I'm a bigger believer in condos longer term.
Got it. All right, here's a good one. We talked earlier about how prices, in your view, are most likely going to be flat next year. Does that pose a problem for valuation? Are appraisals, in a sense, going to become a problem as sellers move forward?
Uh, the When it becomes a problem with valuation is at the moment markets turn, that they go up or they go down price wise. The appraisers, especially in today's industry, they're late to the party is my favorite saying these days. Because they're not local. That you have somebody from Albany coming down and banging out 8 appraisals in one day. They don't get the nuances of the market versus somebody lower. And I'm speaking, I'm clearly biased as a
This is
local.
since the great financial crisis. That's
Right.
the result
Absolutely, it's
of that.
gotten worse. The appraisal quality has gotten worse. I've testified in Washington about it. Like it's just it's a shame. And it's shifting towards automation. Think Zestimate, right? So
So is AI replacing parts of pricing? Yes or no?
yes, I think so. It isn't the panacea like that everybody thinks it is, but it it removes like the clerical aspect of how you come up with a value or what you have to go through. So it accelerates the valuation process, but is dangerous if you rely on it.
Right. I guess that's the next question. The follow-up here is most real estate data misunderstood?
Um, so the answer is yes, and most of the time it's mispresented. It's if I tell you the median sale price went up 4.2%, you know, well, that doesn't tell you that the high end went down and the low end went up or vice versa. Like, it's much more nuanced than that. It's like, do you rely, like, why do we get monthly annual or monthly U.S. housing reports like NAR, existing home sale, Case Shiller, all that research, national, everybody's debating national. What does that have to do with your house and your neighborhood and your prices? It has nothing. So literally every day, everybody is bombarded with national numbers, and like there's a sentiment is up, sentiment is down. And the problem with that, and the reason why real estate agents should care about that, is because their sellers or buyers are reading that stuff, reading that crap. Let's call it what it is. And so as an agent, you've got to understand it and understand, more importantly, why it's ridiculous. So
Yeah.
it's a PR
Yeah.
opportunity.
Well, it also gives us an
Yeah.
opportunity to show our advisorship and our expertise and
Absolutely, to
value.
drill down into a market. Yeah,
Right.
absolutely.
A
I mean,
bunch
what
of
you
good
guys do
questions.
is exactly what we should be doing. It's like
Right.
getting under the hood, as John said in the
The
beginning.
interpretive layer of the transaction.
That's where the value is. It's not about access to the numbers, it's about telling an accurate story so that people can make informed decisions off of, in my case with the market study, like a neutral market benchmark, where I don't care like I can't tell you how much litigation we do or how much matrimonial work we do where, one party, one party is the bad guy and one party is the good guy, and you don't really know. It's like you shouldn't care about any of that. What is happening in the market,
Yeah.
period.
You got to be what they used to call a shade tree mechanic. You have to open up the hood, see what's going on, specifically be able to fix it. All right, Jonathan, the last on the speed round question. I think Noah's going to get to the chat questions after that. But look, if you had $1 million to invest in real estate, or I'll give you more than that. You have an unlimited budget, Jonathan, because you are so special. What would you do with it? Specifically in New York City, where would you
Um,
invest? Or
well, the
would you
first
just put
thing
it in
I'd do,
T-bills? That's fine too.
yeah, yeah. Well, the problem is that what I would do and what I would end up doing, because my wife is financially responsible and I'm not financially responsible. So you know, like I would be, homeless right now if I didn't have her. She's our CFO, and I get my paycheck from her through Miller Samuel. Um,
She still
uh,
pays you?
well, not regularly, but it works out. Um, what I've always wanted to do was own and I'm sort of not answering your question because I don't really know, other than I've always wanted a loft in Soho and they don't exist anymore, with massively spray painted outside with tagged outside, and you go in and it's this beautiful place the size of a basketball gym. That's what I really want, and
That'd be
maybe
awesome.
someday I'll get that, but it won't be $1
Okay.
million. That
Well,
that's
we just
like the
need to,
No.
monthly. That's like the
we need the
monthly mortgage and
John.
common charge and
Yeah,
taxes.
the Jonathan's Loft GoFundMe. We'll set that up for you, Jonathan. Don't worry.
Absolutely right.
All right, guys. I got a few more questions here. I want to get them in. This
Sure.
is a great question. What is noise versus actual policy in relation to the new Mamdani administration in general? Specifically, can he and will he raise property taxes?
Uh, so my take. First of all, I have a lot to say about Mondami, and I don't live in New York City, so I couldn't vote, but I probably would have voted for him. And the reason why I say that is because um, you know, there are some things that we have to do. And the first thing I want to see is I want to see a plan. I want to understand what we're doing. We've never had one, really, since the Bloomberg administration, which I think fixed a lot of wrongs in the city. I do think there probably will be an increase of some kind, but the problem is, we're sort of dependent on input from the state, and there's a lot of fear mongering from the real estate sector about Mandami. There was, leading up to the election, which made me very angry because he wasn't a household name until the first week of July, and there were all these news stories about real estate agents in Greenwich saying that the wealthy were running from the city, and brokers in Palm Beach, Florida, were like so excited, hoping you get elected because they'd want, there's going to be a fleet, the wealthy are going to leave the city and they're gone because, it's socialism and all that stuff. And what happened was, the reason why the Greenwich brokers were phones were ringing off is because Wall Street had the biggest year in history, and Greenwich is sort of the suburban bastion of the wealthy securities industry types. And I know, like, my sister used to live there. It's like you can't believe it. And so when I looked at that, I said, well, let's look at actual data. And what happened was, contract activity for high-end housing the month before the election was way up, and then the month after the election it was way up again. And so that, last time I checked, it takes two people to sell a property, a buyer and a seller. And so if buyers were or sellers were fleeing the city and prices are rising to record levels or near record levels, that doesn't sound like people fleeing the city. And the same thing's happening with the talk about higher real estate taxes. We have the same argument in California with the billionaires tax that was being floated. and you have all these stories of, Sergey Brin and Elon Musk like fleeing to Florida, right? To buy big mansions, and that gets covered. But those are tech bros who are not, they're very mobile. And the sort of blue blood Californians born and raised there, built their business there, aren't going to move to Florida. Right. And this is the narrative that we're sort of playing with. And he is under significant scrutiny. I don't know if he'll get exactly what he wants. But I do think there will be a tax increase, and I don't think it'll really make much of a difference. And by the way, the contract activity in South Florida, no increase. After the election, or even the 6 months before when he became a household name, no change. I'm looking at the actual information. So
non-event.
Regardless of what your public or what your opinions are, if you go through this New York or this real estate industry and you use housing data as a proxy for supply and demand, people migrating, not migrating, I have no evidence right now.
Jonathan, so. I'm sorry, this is a speed round violation. Too long on that one.
You were doing so well, Jonathan.
Doing so well.
I'm sorry.
But speaking of narrative, I want to get to one of the other questions in the chat. This is a really great one. You got a condo seller who's basically saying, I don't want to list with geopolitics being what they are. I want to wait. What kind of thing does a broker, how do you respond to that? What's the sort of the narrative flaw in that statement, or is there one?
So, so is this still a speed round?
Yes.
All right.
Because it's already noon.
My kids accuse me of being long-winded. Now I'm hurt because you guys are doing the same thing. So I think that the someone that talks like that probably isn't a seller. They're not ready. And so I'm speaking from my 6 months as a real estate agent 40 years ago. I would say that if you really hard sell them on, why you should sell now and forget geopolitics, I just seems like a losing battle. Maybe I'm wrong, but I don't see that as a good move.
They may not be ready, and if you're a seller and you tell that to your broker, you're not going to want the broker to come back to you and start to push you and pull you and add more stress to it.
Makes them uncomfortable with you.
Yeah, you said something before. Is that everything about what we're doing is about helping the client make an informed decision, not pushing and forcing you into a decision.
Right. It's all about providing a neutral benchmark, and then they can make informed decision on what they want to do. Listen, when the market is weak, some people thrive in that market and buy and are active, and because they see something that other people don't, and other people are, have the herd mentality and they want to do it when everybody else is doing it, was probably the wrong time to do it. Right. So,
right.
Don't press.
I agree.
But I'm not in sales. So I don't know.
Well, Jonathan, I think we've reached our end of time here. I mean, this has been really fun. We covered a lot of topics, a couple of spicy and hot topics, which we promised you we would do. We would promise you would do. You always like to keep it spicy. I hope you guys got some good takeaways from Jonathan. You got his housing notes over there. Definitely subscribe to it. Reach out to Jonathan. You never know when you may want to talk to him or do business with him or anything, or have a situation where you might need an appraisal, right?
Or you need a dad joke. Maybe.
Or you need a dad joke. Exactly. But again, this was great. It was excellent intelligence. Jonathan Miller Samuel, John Walkup.
Thank you,
I am
guys.
Noah Rosenblatt. We are with UrbanDigs, and we will catch you guys next time. Thank you, and good luck, everyone.
Thanks, everybody.
Cheers. Good morning, everybody. Thank you guys so much for joining. Good morning to John Walkup.
Good morning, Noah.
Good morning to Jonathan Miller. I was waiting to say that. It just sounds great. We should do this more often, Jonathan, like once a week.
Listen, I'm happy to. I always love talking to you guys. It's always fun.
We should shooting the shit.
Is daily basis too much? I mean, 15 minutes a day. That's all we ask, Jonathan. I mean, just